Welcome back to Talk Tickers, everyone. This is where we break down those dense earnings calls into something you can actually, make sense of. Today, we're jumping into Chatham Lodging Trust, ticker CLDT. Their Q2 2025 results just dropped.
And it's an interesting one. Not really a story about massive growth right now.
Exactly. It feels more like a transition story. Our goal today is figure out why the stock actually ticked up, maybe 1.5%, when RevPA, a key metric, was slightly down.
And the answer really seems to lie in capital allocation. They basically finished a big cleanup.
Right. And now they're showing us what they plan to do next, the tools they're going to use.
Yeah, that's the lens, definitely, because operationally, you might just scratch your head a bit, but the market liked the strategy. So adjusted FFO per share came in at $0.36.
Which beat the consensus, right? What was that, $0.34?
Yeah, beat the $1.34 consensus. And importantly, it hit the very top end of their own guidance range.
Okay, so they managed expectations well and well delivered. What about revenue?
Revenue was also a slight beat. Came in at $80.3 million, just ahead of the $79.7 million expected. But like you said, the core ops were a bit softer. RevPAR, that's revenue per available room, was down 0.4% compared to last year.
Okay, 0.4%. But management pointed out that was better than they initially guided for.
Exactly. So the stock reaction tells you investors weren't sweating that small RevPAR dip. They focused on the FFO beat and, I think crucially, the strategic moves. Plus, pricing power looks solid. ADR, average daily rate, held flat at a pretty strong $191.
And occupancy.
Occupancy hit 82%, which management mentioned is actually a post-pandemic high for them, so they're filling the rooms.
Right, just maybe not pushing rate quite as aggressively yet.
Yeah.
Okay, let's get into that strategic story then. Capital recycling, deleveraging, what were the big moves?
Well, the main event was portfolio pruning. They sold off 5 hotels, older ones, lower RevPAR contributor.
Okay, how much did they get?
$83 million. And the goal was clearly to shed those aging assets, average age was like 25 years, and reinvest, or rather, delever. They got about a 6% cap rate on the estimated 2024 net operating income, the NOI.
Okay, so for listeners, NOI is that operating income, a 6 cap. Basically, they sold relatively low-yielding properties for a big chunk of cash.
That's it, exactly.
Right.
Like selling off some older rentals to pay down the mortgage on your best properties sets you up for the next step.
And it really strengthened the balance sheet, didn't it?
Oh, massively. Leverage is way down. We're talking about 21% of total hotel investments now. Or look at it as net debt to EBITDA, about 3.5 times.
Wow, 3.5x. That's pretty conservative for a REIT, right? It gives them a ton of flexibility.
Extremely conservative. Huge capacity to maneuver. They've really cleaned things up on the debt side.
And they didn't just sit on the cash, they put it to work signaling confidence. They actually launched their first ever share buyback program.
Yep, first time ever. Authorized for $25 million.
Do they start using it already?
They did. Jumped right in during Q2, repurchased just over 20,000 shares. The average price was $7.02.
$7.02.
And they said something about Q3 plans.
Yeah, this is interesting. Management explicitly said they intend to be a bit more active in the third quarter, especially given where the share price is.
That's a pretty clear signal they think the stock's cheap.
You bet it is. Putting their money where their mouth is.
And they're also working on the debt side too, right, to lower costs.
Correct. They're planning to upsize and recast their credit facility and term loans, basically trying to lock in better rates and terms now that the balance sheet looks so much better. More cleanup, locking in the gains.
Okay, let's talk margins. Because even with flat RevPAR, hotel GOP margin actually went up.
It did. Hotel gross operating profit margin grew 30 basis points, hitting 46.3%, which on the surface looks pretty good. Strong operational control.
Wait a second, though. I remember seeing something about one-time items helping that number, like refunds. Ugh, sharp eye. Yes, that's true. There was about $1.3 million in non-recurring benefits from workers' comp insurance and some tax refunds that definitely helped the headline number.
So if you strip that out, did the whole gain just disappear?
Yeah.
How much real expense control was there?
That's the key question, isn't it? Management adjusted. They insisted that even if you exclude those one-offs, their core labor and benefits costs were still down year over year on a per occupied room basis.
Okay, so the headline number was flattered, yes, but there was still some genuine underlying cost control happening. They were managing expenses.
Exactly. They're fighting those cost pressures effectively at the hotel level.
It's always a but. What was the offset?
Guest acquisition costs, commissions related to getting guests in the door were up about 15%.
What was that?
just shifts in booking channels. Probably more business coming through, third-party sites which charge higher fees. That actually shaved about 30 basis points off the margins.
So basically canceling out the underlying operational gains if you ignore the refunds. It's that constant push-pull.
It really is. Filling rooms versus the cost of filling them.
This shifted geography. Where's the demand coming from?
Yeah.
Because the mix really seems to highlight why they curated the portfolio this way. Silicon Valley still the star?
Absolutely. The engine right now.
Yeah.
RevPAR there was up a healthy 3%.
And that's driven by
Continued big tech investment. Think NVIDIA. Applied Materials expanding near Chatham's key hotels there. It's providing a really strong base. And management loves to point this out. It means they've beaten overall industry RevPAR growth for 14 straight quarters now.
14 quarters. That's impressive consistency.
It really is. Shows the power of that specific market exposure.
But the call was also pretty clear about where the weaknesses were, some significant headwinds in specific spots.
Definitely. Texas was tough. Austin saw a really big RevPAR drop, down 14% in Q2.
Ouch. What happened there?
Mostly city infrastructure stuff.
Oh.
The main convention center was closed for a big expansion project. That really hurts city center hotels. Downtown Dallas had similar convention-related issues.
Okay, so localized problems, not necessarily a demand collapse. What about the Pacific Northwest?
That was interesting. Seattle and Bellevue were softer, and the reason cited was a big drop in Canadian travel.
How big a drop?
Get this, auto border crossings in that area were apparently down 47% in the quarter.
Wow, 47%. That's a huge localized shock. Shows why you need diversification.
Precisely. You can't rely on just one source of demand. But there were bright spots, too. Sunbelt markets like Charleston, Florida did well, and Pittsburgh had a massive quarter. RevPAR up 23% thanks to hosting the U.S. Open.
Right, special events can really move the needle. Okay, before we look at guidance, I want to touch on something else they mentioned, internal value creation. Converting meeting space.
Yes. This is a clever little strategy. They're taking some existing, maybe underused meeting rooms and other spaces and turning them into 8 new guest rooms.
8 rooms doesn't sound like a lot, but is it impactful?
It's more impactful than it sounds. Management thinks it adds maybe $3 to $4 million in value to the portfolio overall. And crucially, they're doing it for way, way less than the cost of building new rooms from scratch.
Smart. Especially with construction costs being so high.
Yeah.
Kind of like finding hidden value within their existing footprint.
Exactly. High ROI, low risk compared to a ground-up development like their Portland project. Keeps them nimble.
Okay, let's look ahead then. Guidance. What's the outlook? What was the tone?
I'd say the tone was cautiously bullish, maybe just cautious optimism. For Q3, they guided adjusted FFO per share to $0.29 at 33 cents.
Okay. And for the full year?
Full year 2025 RevPAR growth is projected at flat to maybe up 1%, so pretty modest there.
Flat to plus 1%, and FFO for the year.
Full year adjusted FFO per share projected between $1.95 and $1.03. But it's really important to note the assumptions baked in. They explicitly said this guidance assumes no more asset sales for now.
Right, and it depends on interest rates staying where the market expects them.
Exactly. They're using the SOFR forward curve. So no big surprises assumed on floating rates. They're trying to guide based on what they can reasonably control or predict today.
So it really confirms that narrative we started with. They've moved past the cleanup phase, selling assets, paying down debt.
And now they're entering the compounding phase, or at least setting up for it.
That lower leverage, down at 21%, plus that new buyback authorization, it gives them choices, doesn't it?
Huge optionality. They could look at acquiring assets, although they noted the bid-ask spread is still pretty wide out there, so maybe not immediately.
What else?
Well, they need to fund that Portland hotel development they're working on that's got like a 21 to 24-month construction timeline ahead.
Or more buybacks.
Or more buybacks. Given they said they plan to be more active in Q3, that seems like a very real possibility, especially if the stock stays around current levels.
Which leads to the big question for investors, right? What's the catalyst from here? What's going to actually drive the stock near term? Is it going to be seeing business travel finally pick up meaningfully in Q3, say August or September?
That would certainly help.
Or is it them really stepping up and accelerating those share repurchases under that $25 million program?
That feels more directly controllable by them.
Or maybe, eventually, seeing some smart, accretive acquisitions if those price gaps between buyers and sellers finally close.
Could be. But like you said, the buyback feels like the most immediate lever they can pull right now to signal value and return capital.
Okay, let's shift gears. It's time for our regular segment. This is not financial advice. Just a bit of fun, putting on our imaginary hedge fund analyst hat. What's an outrageous but plausible trade idea based on this CLDT deep dive?
All right, let's do it. Purely entertainment, remember. So the core thesis for Chatham Lodging Trust is this. They have seriously de-risked the balance sheet. Leverage is down to that impressive 21%. They've got an active buyback going, snapping up shares around $7. Plus, they have that concentrated high-quality exposure to Silicon Valley, which seems really resilient thanks to all the tech and AI-related investment. It's acting like a strong anchor.
Okay, got the thesis. What's the trade structure?
The pitch is go long CLDT stock and simultaneously short the VNQ. That's the broad Vanguard real estate ETF.
Ah, a classic pair trade. Long the specific company, short the general sector ETF. Why structure it that way?
Well, the idea is you hedge out the general market noise, worries about interest rates hitting all REITs or overall sector sentiment swings. You neutralize that beta. What you're left with, hopefully, is the alpha, the specific outperformance you expect from CLDT because of their execution, their balance sheet strength, their buyback, that Silicon Valley edge.
So the bet is basically that CLDT's successful pivot from cleanup to compounding isn't fully baked into its stock price yet, especially relative to the broader REIT sector.
Exactly. You're isolating the bet on CLDT's management and strategy, stripping out the wider market movements. That's the hedge fund playbook right there.
A very focused, if hypothetical, pitch. Okay, let's recap the main takeaways from our deep dive today. CLDT beat FFO estimates, hitting the top of their own range. They significantly cut leverage down to a strong 21% through strategic asset sales.
And they launched their first ever buyback, signaling confidence and promising to be more active in Q3.
Plus, while there's some geographic softness, that core Silicon Valley exposure continues to perform really well, providing a solid foundation.
Definitely. And my final thought for you, the listener, to chew on. Management kept stressing that new hotel supply across the industry is likely to stay pretty muted for a while. So if that supply constraint holds, and if the historical link between hotel demand and U.S. GDP growth holds, how much higher could RevPAR growth potentially go beyond 2025? Especially with all this talk of massive foreign investment and tech spending coming into the U.S. economy.
That's the longer-term question, absolutely. The potential leverage to a stronger economy down the road, given limited new competition. Great analysis as always. Thanks for walking us through CLDT's quarter, and thank you all for joining us on Talk Tickers. We'll catch you on the next deep dive.